Hey guys, welcome to Connecting the Dots, the podcast where we follow the breadcrumbs and try to predict where disruptions will take us. In this video, I'll leak for the first time the details of a hidden ETF which focuses on disruptive technologies. This ETF is so good that saying it provides much better results than Ark Invest's ETF is a huge understatement. It consistently crushes them. Just like Ark Invest's flagship fund, Ark Innovation, the main holding of this ETF is Tsla. However, unlike ARKK, this fund doesn't restrict Tsla to only 10% of its holdings, which undoubtedly helps its results. Another similarity to Ark is that this ETF focuses on markets that are ripe for disruption. However, this fund takes a wider approach where Ark looks deeper. This means that where Ark focuses on several sectors ready for disruption and invests in a few companies they expect to lead the disruption in each sector, this ETF too sees disruption in many sectors, yet singles out and invests in just one company in each sector. In this video, I will show the crazy results that this ETF provides. I'll then show which sectors this ETF expects to be disrupted and which companies the ETF invests in. I'll then give details of this ETF and explain why people miss and misjudge it. Finally, I'll explain why I previously decided to leave ETFs and go to single stocks, and why I now think this ETF is not only better than any ETF I know, but also better than buying single company stocks. Your time is valuable, so timestamps are available for your convenience. I am heavily invested in Tesla stock and options, and I recently started investing in this ETF. I am highly bullish on both going to the moon, but everything I say is my opinion only. This is not investment advice, and always do your own research for your investments. If you haven't done that already, please subscribe to the channel and smash the like button to support it. It really helps the channel. You can also support the channel on patreon.com/connectingnodots so I can keep creating content for you guys. Even $1 a month will give access to my exclusive Patreon-only newsletter. There's a link in the description. Now buckle up and get ready, because this ETF focuses on extreme disruptions, and disruptions are never boring. Before going on, let's see what I meant by saying that this hidden ETF absolutely crushes Ark's results. For starters, if you would have put $1,000 on this ETF when this year just started, and I would have done the same with ARKK, then today for each dollar in my account, your account would have showed $1.85. And had we done this 12 months ago, then by now your investments would have grown to over twice my own. That seems impressive. But to be honest, 1 year is way too short to judge an ETF. Such results could be explained by luck, so let's go for 2 years. Had we invested exactly 2 years ago, your ETF holdings would be worth right now over 8 times the value of my Ark Innovation holdings. Granted, even 2 years are ultra short term, and both Ark Invest and the Secret ETF focus strictly on long term. So if we compare both funds over a 5-year basis, this ETF almost 7x'd ARKK's gains. The hidden ETF I will show you crushed Ark's results. But before spilling the beans on that ETF's ticker and who actively manages it, let's first understand what the ETF is all about. The ETF invests in many sectors which it believes face severe disruption. These sectors fall into 3 general categories: transportation and robotics, energy, and AI disruption. The ETF's largest holding is in automobile production, a sector where disruption is becoming increasingly evident. As EV sales rise and ICE sales fall, companies such as Toyota, GM, and BMW should decline, while companies who succeed in making EVs will rise. Tesla is well positioned to take a huge portion of the total automobile market while maintaining huge margins. And since the ETF only holds a single leading company in each sector, it chose Tesla as its play on automobile disruption. Keeping this in mind, I guess we can now eliminate Gordon Johnson and Joe Biden from the list of potential managers of this ETF. Moving on, we'll return to the transportation category shortly, but first let's discuss ETF holdings in the energy category. The first group of energy sectors facing disruption are the fossil fuel production and distribution sectors. As EVs replace ICE vehicles, huge industries will be disrupted. This includes everything there is, from pumping crude oil out of the ground to pumping refined gas or diesel into cars and filling stations. It's very clear that industries such as oil refining will be utterly disrupted, but less clear is that seemingly unrelated sectors such as shipping will be disrupted too, as 30% of all shipping is for transporting oil. In each of these sectors, huge companies such as Shell, BP, ExxonMobil, and $1.8 trillion Saudi Aramco will find themselves out as renewable energy plays such as wind turbines, solar roofs, solar panels, and fast-charging networks rapidly get in. With leading products and services in all these technologies, Tesla wins the ETF's investment spot for disrupting each of these sectors. Another group of energy sectors is electricity generation and distribution. Companies making components for power plants, nuclear reactors, etc. will be disrupted, as will power stations and utilities. This has already started, as building of peaker plants has almost stopped, with GE basically losing its turbine business. Watch Tony Seba's latest videos about clean disruption, and you'll see why even existing power stations are becoming stranded assets. The disruptors are renewable energy companies, of which there are many. Tesla stands out as it holds a full stack of solutions for energy production, storage, and distribution. It is well positioned to become a real force in these fields through virtual power plants and AutoBidder, while also offering AutoBidder as a service to other power companies. In these sectors too, the big disruptor is Tesla, and the ETF chose it here as well. Going back to transportation, we already discussed making cars, and the next transportation sector is ride-hailing and public transportation, which should face huge disruption once robotaxis are figured out. Since Tesla seems ahead of the pack in autonomous technology, it wins the seat for this spot too. And the same goes for car dealerships, because the shift to direct sales of EVs moves the value of dealer networks straight into the car manufacturer's valuation. Tesla is expected to lead the pack, so it received the percentage of dealership disruption as well. Two other transportation sectors facing disruption are truck manufacturing and trucking, the driving of trucks. The move to EVs will replace diesel trucks with electric ones, and the rise of autonomous driving will disrupt truck driving. As you probably guessed, Tesla wins the ETF's investments for these sectors too. By now you might be thinking that, thank you very much, but why should you even buy an ETF that only invests in Tesla when you can buy Tesla stock yourself? The reason is that Tesla is the ETF, and I am seriously suggesting that for investment purposes, ticker symbol TSLA should be treated more like an ETF than like a regular company such as Netflix and Facebook. I'll explain the logic in a moment, but first let me briefly touch on which other sectors Tesla is set to disrupt. Consider this list sent to me on Twitter by Tsla. On the left, we see Tesla businesses, and on the right, there are their competitors. It's not exactly the same as companies that face disruption. For example, in Autopilot, Waymo and Mobileye are competitors in disrupting manual driving, but it serves well to show the scale of the business Tesla is after. So, in transportation, we discussed Toyota, VW, GM, etc., and didn't even mention first, second, and third tier suppliers for powertrain, seats, etc., which are huge businesses by themselves. Borg Warner, Bosch, Lear Corporation, etc., are all in the way of disruption. We also discussed selling cars and servicing them through dealer networks, and used car companies like Carvana and AutoTrader. To give you an idea of the opportunity, let's take one example from these, by the way, half-forgotten sectors of car seats and used car sales. Lear Corporation is valued at over $50 billion, and the same goes for Carvana. Tesla makes its own seats and sells its own cars, and if things go as planned, this means a huge portion of these businesses will be eaten by Tesla, and the market fails to realize this. Going to energy, we already discussed the supercharger network replacing gas stations, we talked about solar panels and roofs disrupting energy companies, and mentioned AutoBidder and virtual power plants disrupting utilities. I didn't even mention small change disruptions, like solar roof possibly disrupting shingle-making companies, but even that small change includes $10 billion in revenues per year for asphalt shingle sales alone. But Tesla is also a battery cell company and branches into mining and possibly recycling. And it's a general engineering company, further strengthened by purchase of Grohmann Engineering with its manufacturing automation know-how and of Highbar with its fast injection techniques. And Tesla is an advanced chip designer, which can rival NVIDIA. NVIDIA alone is worth 71% of Tesla's price, none of which is currently recognized in Tesla's valuation. And speaking of chips, soon there will be Dojo, which if Tesla wants to offer to the public could be a formidable competitor to Amazon's AWS and Microsoft's Azure. I'm sure you know that Amazon's huge valuation is mostly due to AWS, but even Azure is a monster. It has already passed Windows and Office 365 in revenues, and next year it's expected to take the top revenue crown from Office and become Microsoft's biggest cash cow. But look forward one extra year, and you'll see it leaving everything else in the dust as it continues its exponential growth. That's one huge market that Tesla can bite into, and it too isn't recognized in the valuation. My CTO friend Kim thinks Tesla will never offer Dojo to others, but that only means they will have other, even more profitable uses for it for themselves. And Tesla is in a great position to disrupt car insurance and later most other fields of insurance. And they're turning into a monster AI company, so there's a chance they will make the bot for which the total addressable market is practically unlimited, and maybe also win artificial general intelligence, for which the total addressable market is unlimited too. The best way to sum it up is through this iceberg meme created by the guy with the best username on Twitter, Dr. M. Code Ding, which goes by XDreamCoding on Twitter. So, Tesla is about to disrupt so many markets, but we know that already. But why does that make it an ETF? Let's list all the reasons for buying ETFs and see which checkboxes Tesla fills. ETFs are publicly traded and can easily be sold. Tesla fills the checkbox and then some, as it's the most traded stock available. Multi-sector ETFs avoid the idiosyncratic risk associated with a single sector. They provide exposure to several sectors, and if one sector slumps, another can keep your investments afloat. Tesla is multi-sectorial too. Currently, it is valued mostly on cars, but energy and other parts of the business will soon take a more significant part, so it should provide the same level of multi-sector protection as other ETFs. ETFs also avoid the idiosyncratic risk associated with a single company. In other words, they protect your investments from holding a single company and see it crash. This one is true, and had you asked me a couple of years ago, I would definitely have said that ETFs are much less risky than owning Tesla stock. Back then, Tesla could easily have crashed, but a lot has happened in 2 years. Tesla has turned into a hugely profitable cash machine, with huge positive cash flow and a bulletproof balance. It has very little debt and can raise capital faster than anyone, so the chances of Tesla going belly up in the foreseeable future are next to zero. So it too provides protection against a single company failing. To push this point through, imagine putting your money in an automotive ETF, such as the NASDAQ Global Auto Index Fund, ticker symbol CARZ. This ETF holds stocks of all major car manufacturers. So buying it is akin to putting 8% on Tesla and 92% on companies such as Toyota, GM, Daimler, VW, and Honda. Tell me in the comments below whether this type of diversification would make you feel safer. If you ask me, I sleep much better knowing my money is invested in the Tesla ETF rather than the Cars ETF, despite Cars diversifying over several companies. But of course, you won't invest in cars, so let's take it one step further and consider buying into a multi-sector ETF, such as NASDAQ following ETFs. Chances are you won't get rich doing this, but this diversification could be a fair strategy if what's important for you most is protecting your money and getting steady growth. This strategy has worked well for ages, but we are now at a time of disruption, and what worked before won't necessarily work looking forward. Breaking it down, a multi-sectorial ETF is like a combo of several single-sector ETFs such as cars glued together. And just like cars, most of these sectors are about to be disrupted by Tesla, along with other players which aren't currently in the index. As we discussed for Tesla, a huge number of sectors and companies are about to get their cheese snatched from them. So in my eyes, investing in an ETF which holds all these value traps is riskier than holding the Tesla ETF. Kathy Wood agrees. Here's what she had to say of this.
And by the way, we think the benchmarks are where the big risks are longer term, because they are filling up with value traps. Those companies that have done very well historically, but are going to be disintermediated and disrupted by the massive amount of innovation that's taking place. Just to give you one number there. Right now, we believe that innovation, truly disruptive innovation, is priced in the global marketplace, public markets, at roughly somewhere between $10 and $15 trillion. In 10 years, we believe that number will be 200 trillion. So it will go from a little more than 10% of global equity market caps to what we believe could be more than half. That's how much disruption is evolving thanks to DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, all of which are converging so that S-curves will be feeding S-curves. We are on the threshold of the most innovative period in history, bar none. You have to go back to early 1900s, telephone, electricity, and automobile to see anything like it. This 5-year investment time horizon is critical. The next 5 to 10 years, we think, are going to be spectacular. Will there be volatility? As you say, ARK already is a volatile strategy. And that is why we say, keep your eye on the prize. 5 years, the world will look nothing like it looks today. And we're invested in all of the disruptors, the winners that are going to disrupt the traditional world order.
Chances are that you too think that the Tsla ETF is better and safer than index investing. So now is the time where I say that in my eyes, it's also better than disruption and innovation ETFs such as ARKs. Better is a pretty wide blanket, so let me be specific. Long term, the Tsla ETF should provide better returns than ARKK while exposing you to lower risk. You heard that right. It will give better returns with lower risks. Before I explain why, I'd just like to remind you that none of this is financial advice. I did study some finance and company analysis as part of my MBA, but I'm really not qualified to give any financial advice. I'm just an engineer, a random guy on the internet sharing out his offbeat thoughts. Also, everything I'll say here is long-term only. The Tsla ETF is so volatile that if you're thinking short-term, Ark Invest or even parking your money out of the stock market should be a much safer bet. Over the long run, however, market valuation usually catches up with true company value. So long-term, volatility can be ignored. Repeating what I said above, long-term, I expect the Tsla ETF to A. Deliver much higher returns than ARK, and B. Do so while being safer. Okay, let me backpedal a bit. I previously said that it's wrong to treat Tsla as company stock, and we really should think of it as an ETF. I now want to backpedal on that, because although Tsla stock isn't like regular company stock, it's not like an ETF either. It's a new kind of ETF, a better one. Let's look at returns. Looking back in time, once Tsla hit its stride, it started giving crazy returns, which are much better than ARKK. As we previously saw, over the last 5 years, the Tsla ETF gained 2,899%, while ARKK only gained 425%. But it's not the difference in past returns that I'm looking at. It's the reasons for that difference. One huge reason is ARK's policy of not letting a stock ride much higher than 10%. For this reason, despite maintaining that they have the highest conviction in Tsla relative to all other stocks they hold, ARK constantly sold Tsla stock to buy stocks they had less conviction in. In my humble opinion, this cannot be justified. Let's say you have 10 stocks that you have equal conviction about. So you invest 10% in each, and next week, one of the stocks surges. Assuming your conviction about them remains the same, it does make sense to trim some of the excess gains and spread them among all other stocks. But if you're convinced that one stock is much better, and you're convinced that the surge will continue, and you tell everyone that the only reason you're selling is your internal rule, then to hell with that rule. I do understand why ARK is doing that though, and that's because it reduces short-term volatility, reaps some trading revenues, and mostly because who on earth would buy ARK's funds and pay them their management fee if they let Tsla grow to 80% of their holdings, right? So ARK has to trim Tsla down despite their conviction. But as a private investor, I do not have that limitation. But should I? And should you? I think it all boils down to whether Tsla really is a better kind of ETF like I previously said. If it is, then it should be enough to hold Tsla shares. But if it isn't, then maybe diluting, like ARK does, provides some layer of safety. And here's the clincher. Tsla is a better kind of ETF because of the following points. I'll give them in ascending order, from least to most important. The first reason that Tsla is a better ETF is that with all other ETFs, including ARKs, you pay for all their holdings, while in the Tsla ETF, you only pay for Tesla Motors, and all other holdings are for free. The reason is that currently the market only partially prices in some of the holdings, and most others aren't priced in at all. For a long time, all Tesla analysts priced Tesla based on automotive alone. Recently, some started taking into account some of the energy business. But even now, most Tesla analysts, including those with the high price targets, still judge Tesla based on its car business alone. They don't even consider Tesla energy, let alone the other sectors Tesla is ready to disrupt. So basically, with all ETFs, you pay for all the holdings. But with the Tesla ETF, you only pay for the top business and get all the other shares and options in the ETF for free. That's something nobody else can beat. To push this through, here's an example. Everybody is speculating nowadays on when StarLink will IPO and are anxious to get in. And if you're anything like me, I'm sure that's true for you too. Now imagine that instead of SpaceX, StarLink was part of Tesla. 5 years ago, StarLink was not much more than an idea and a small startup that few people thought would succeed. Had you purchased Tesla ETF shares 5 years ago, StarLink wouldn't even nudge the share price. So buying Tesla would have given you shares in that StarLink startup for free. How do you like that idea? Unfortunately, StarLink is part of SpaceX, and we missed on that opportunity. But you know what? The Tesla ETF has lots of StarLinks for free. Take Tesla Insurance. It's in a more advanced stage than StarLink was 5 years ago. Its way to success is much less risky than StarLink's was, and its potential value is higher. Yet it's still offered free of charge in the Tesla ETF.
Dude, you're putting 100 tons in orbit, and you're probably going to beat NASA to the moon. Do you really doubt that he's going to solve insurance for cars? Is that the world's hardest problem?
When you put it like that, Adam, it does seem like solving car insurance is going to be a pretty simple task.
Figure it out.
Yet it's still offered free of charge in the Tesla ETF. Seems like the deal of the century to me. But as I said, this is the least important reason on why the Tesla ETF is better and less risky than any other ETF, including Ark Invest. So let's go to the next rung up the ladder. On to the second reason, which is management. The main reason people buy Ark Invest's ETFs is because they believe that Cathie Wood and her team of analysts really get disruption, so they know better than other analysts where to park your money. Well, guess what? The Tesla ETF also has a manager. His name is Elon Musk, and he is the greatest capital allocator I know, and he too decides where it's best to park Tesla's money. For example, if he sees that Dojo as a service has amazing potential as an AWS alternative, he can go pedal to the metal on that and push it forward faster. But if he thinks that other parts of the business can do better, he can divert focus elsewhere. At the extreme, if he sees it's a dud, he can stop funding Dojo altogether and let it die. That being said, if after all the investing is done, Tesla still holds cash, they can even park it on Bitcoin. So the Tesla ETF is managed by a great allocator, but that's not why it's a better ETF. It's only a stepping stone to the third reason, which is capital use. You might say that Cathie Wood is better at finding where it's better to park your money, and that's debatable. What isn't under debate is that Ark only parks your money, while Elon puts Tesla's funds to use. If Ark decides that Palantir is a good opportunity, they'll buy its shares, but this doesn't affect Palantir's chances of success. However, if Elon decides that Dojo is a good opportunity, he will actively divert efforts there and improve its way to success. This matters. Some of you might point out that Tesla doesn't actually use your money. It uses its own funds, but these funds are vast, so all that matters is that their money allocation can actively improve the prospects of good ETF holdings, while Ark and other ETFs have little effect on that. And here's the final reason, which is inside information. When Ark Invest decides whether to include a business in their ETF and how much to invest in it, they can only use public information. They can only estimate which problems or breakthroughs a company has, and only know it for sure when it's made public and priced into the stock. Having access to inside information would improve their investments immensely, but unfortunately, they don't have any, and it's forbidden by law. But all this doesn't apply to the Tesla ETF. They have lots of detailed data on every test they make and every idea they pursue. They know which deals they strike and at what price. They know the demand for solar and insurance. They know how far ahead they are in AI. They have so much data that their decisions on capital allocations are much better and safer than anything Ark Invest or any other ETF can hope to achieve. This makes the Tesla ETF a better kind of ETF, which nobody else can touch. To sum things up, just like an ETF, Tesla holds businesses in many sectors. Just like an ETF, the fear of your funds disappearing due to one company going bankrupt are very low. And just like the best of ETFs, the Tesla ETF focuses its holdings on disruptive innovation. But unlike Ark Invest's ETFs, the Tsla ETF isn't bound by a 10% rule. They are free to invest in whatever holdings they see most promising. And unlike any ETF, most of the Tsla ETF's holdings come free. It's like getting a piece of StarLink for free when buying shares a few years ago. And the Tsla ETF is run by one of the best money allocators around, Elon Musk. But unlike any ETF, his allocation of funds can boost the prospects of success of promising parts of the ETF, while not throwing money at duds. And unlike any ETF, the Tsla ETF has extremely detailed inside information on each of its holdings, so they can make better and safer decisions than any other ETF can hope to achieve. Let me know what you think of this in the comments below. And this time, it's important. I want to hear your points on this, because unless someone shows me where I'm wrong, I plan to sell whatever's left of my ARKK holdings and buy Tsla ETF shares instead. If you found this video interesting, please like and subscribe to help me start growing the channel. Also consider supporting me on Patreon for as low as $1 a month. It'll really help me invest more time so I can deliver quality content faster. So if you want to support the channel and get access to my exclusive Patreon-only newsletter, you can head over to patreon.com, and together we can make this channel grow. A special shout out to my Patreon producers, Katrin L. and Rolf. It really means a lot. And a huge thank you to all my patrons: Thomas C. Ham, John Turbeck, Benjamin Kearney, The Dude, Michael Wayshak, Antonio Cesar, Hanson Monte Pagado, Brad Crosby, John Way, Lee Sweet, Sager Mason, Richard Kesse, Bob Niewold, James, Andy Roberts, Michael Plotkin, Andrew Trainer, Sebastian Bergman, Ronald M. Harrison, and Ken Trudell. I truly appreciate your support. Feel free to contact me and follow me on Twitter, where I am Connecting No Dots. I really appreciate your being here. It means a lot. Till next time, I am Connecting the Dots, and you are amazing.